Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and investing. I'm Stacy Smith, and if you're watching or listening to this program, we urge you to hit the like or the subscribe button. The Nasdaq and the S&P 500 last week suffered their worst one-week loss in a couple of years. We'll take a look as to why that might have happened. Also, we'll discuss the bond market and if they become more attractive when the Fed cuts rates. And will a rate cut really help the housing market? And finally, buying stocks and bonds on margin. Should you do it? And with me to talk about the economy and investing is my panel of advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, based in Pittsburgh. Also, Frank Rossetti of HF Management Company, which is an alternative investing group. Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks once again for all of you for joining us. It's been an interesting couple of weeks with the stock market. In the 9 days since the last time we met, all of the major indices have declined, and the raw numbers look kind of scary. The Dow down 830 points, the S&P 500 down 225, and the Nasdaq down nearly 1,200 points. But, as all of you like to do, when you take those numbers as a percentage of the indices value, it doesn't really look all that bad. The Dow was down 2%, the Nasdaq off by 6%, and the S&P 500 down by 4%. Now, a good portion of those losses came on Friday, this past Friday, after the release of the August jobs numbers and the revision of previous monthly jobs reports. So, Carrie, why are the markets giving up ground based on those jobs reports?
Well, because the economy is 70% made up of the consumer. So when you look through to some of these revisions, along with some other economic data that has been coming out, job openings, unemployment claims, continuing claims, those sorts of things, you start to develop a picture of a possible recession. And, Stacey, I really appreciate that you took the raw numbers and put them into percentages, because percentages are the only thing that matters. As the numbers get bigger, the numbers get bigger. But the percentages really tell the story. And it's just, for all of the hype and everything else about this decline and how big the numbers are, for the Dow, it was 2%.
Right.
Like, that's like a day. Like that, it just feels so much more because the numbers are bigger. But
if I can just say something
Sure.
about that, though, and that is, though, that I believe for the S&P 500, that was the worst week for the indice since March of 23, and the Nasdaq, it was down 5.8% in 1 week, worst week since 2022. So I agree with you about the percentages and the big numbers, but those are still healthy declines.
They're healthy declines, but they're normal. That's the thing. I get it. We haven't had it in a while. And for those of us in the industry, we know how healthy it is to have these corrections. And this right now, depending on what happens over the next, month or so, this is not even a correction. You need 10% to get to correction territory. And, we like to see that once a year, because then it kind of sets up for the market to rise again. So, we don't look at the pure numbers and percentages necessarily as abnormal. However, when you look at the data, that's really what tells the story. And the big issue and the thing that came out of this decline, the questions that everyone's asking, as you're asking, what does it mean? And what it means is that the markets are fearful that we may be cooling off and slowing down, going into recession along those lines. And I think that really may be the case. We may be seeing things slow, but you have to play that out. And, we've been through, I feel like us as a group, we've been through a lot together over the course of the past, I don't know how long we've been doing this, couple years. And all this talk about interest rates going up and interest rates coming down. And our message has been, be careful what you wish for, because everyone wants rates to go down. but they didn't play it out to say, why would rates go down? Well, they'll go down if the economy is slowing and going into potentially recession. So if that is the case, here's what's going to happen. If we go into recession, the Fed's going to lower rates, and they'll keep lowering rates until we get out of recession. And then we'll be in an expansion again. So it's called the economic cycle. It's actually Econ 101. And that's really for us who are working directly with clients. That's what we have to be explaining to them.
I have a couple of things. I concur completely with you, Carrie. Friday was an anomaly in that it was a 4-day week of Labor Day. We were off on Labor Day. So a lot of market participants were not sitting at their trading desks. They either slid out early, making it a 3-day week, or they just never came back from vacation. So that always exacerbates market moves. If good news came out, it would have rocketed up, right? So you have to look at the context of what the market's doing with market participants because, well, it's the math modeling thing, what I love. But, on days where people aren't at their trading desks, news really has outside moves. But that being said, we don't have to have economics 101. We can get in our cars, drive around, go to stores, go to restaurants, and notice there's fewer people out there. I mean, I have noticed this. And I think it shows that we are not going into a slowdown, but we're already in a slowdown. And we just don't know how slow is going to be. But it does show up in the markets because, people are afraid and they know that the companies that they own may not meet their objectives that they bought them for. So it's a concern. And, this too shall pass.
Things always pass. The slowdown that's happening, you have to put it a little bit in context. Over the last 4 years, we've had an incredible amount of capital pushed into people's pockets due to COVID. And that flush of money created a lot of housing, created a lot of expansion of homes, created a lot of cars being bought, created a lot of outdoor kitchens being built, all sorts of things that happened that maybe might have happened over time, but they happened during the lockdown period. That money has pretty much flushed its way through the economy, and now people are living on their paychecks. And although their paychecks have improved dramatically, they're not getting this added money from the government and haven't been for a couple of years. And it's running out. So our economy is becoming, I think, normalized, where you buy what you need and you save for what you want, instead of you wait for the government to hand you a check and buy what you want. And that being said, it's now up to corporate America to become efficient and provide products at prices that are not going up too rapidly, and it looks to be happening, and what have you. They keep talking about, to change the subject slightly, a soft landing. I'm not interested in a landing. To me, a landing means the economy quits growing. That's not a recession, but it's not good. I would rather see the plane fly at a normal height and just kind of keep plodding along, such as the turtle, instead of being the hare as it has been lately.
Michael.
Sure. So I'm the glasses half full kind of guy right now, I guess, as opposed to these three doomsayers that I'm talking about here. I think that the market was, last week especially, it was just priced to perfection, kind of like NVIDIA when they reported earnings a couple of weeks ago. I mean, they had, Kim, what was their revenue in the third quarter? It was something like,
I don't remember, but it was
like
billions of dollars. Yes.
Instead of 250%.
Yeah, and they grew and grew and grew, but their stock fell off like 10%. It was the biggest one-day decline in stock market history, but it was just priced to perfection. And I think the U.S. economy or the stock market was sort of the same way. Our valuations are stretched. We had a jobs number that wasn't great, but the economic data still, I think, looks pretty solid. Wage growth is accelerating at about 3.8%, which is well above pre-pandemic level. Retail sales came out; those are pretty strong. Consumers, people are still buying things. Even though we might be slowing, that's as Carrie pointed out, that's part of the economic cycle here.
Mm-hmm.
So all in, I think it's a healthy correction we saw last week, but things look to be somewhat progressing. And as Carrie pointed out, if they get worse, the Fed's going to cut, and I think that's what we're going to see again in 1 week's time. The Fed cut rates 25, 50 basis points or so. But overall, I still think the economy looks pretty good, even if we are trading at lofty valuation multiples. You'll see some volatility in the back half of the year.
All right, I have a question about the jobs, and this goes back to the fact that if going what Kimberly said, and that is to drive around, take a look, and see what's happening. I drive around, and some of the smaller businesses still have help wanted signs out, and so I mean, it's I'm not quite sure how you read these jobs reports. Are they based mainly on some of the bigger corporations, or does it take in all of America?
It is a mess. I have to tell you this whole jobs thing. What the government does is they have a household survey where they literally call people on the phone and say, who's employed? Were they employed last month? All these kind of questions. And then they, extrapolate. So these are very educated guesses, but not great guesses. And they try to do it in such a way that, encompasses the whole of the economy geographically, in all kind of slices and dices. But guess what? As much as I love math modeling, the first thing I tell people about math modeling, it's imprecise and it's a pale shadow of what the real world is. So that's every time you get jobs numbers, you have to remember that pale shadow, because it could be better, it could be worse. And they do a lot of monthly corrections. So it is, but it isn't really a great snapshot. Now, I will tell you that the weekly unemployment numbers are better, because what these are the results of states saying who filed for new unemployment claims. So oddly enough, the opposite of hiring, firing, that we have a pretty good control over. And if you take a 4-week average, it can get all the mess out of there of like people not, sometimes states won't, they forget to add, call up the Bureau of Labor Statistics and throw that in, give their numbers. But by and large, they are pretty good numbers to give you an accurate read. Hope that helps.
So
I would say when it comes to all of these numbers that are supposed indicators, I don't believe getting bogged down on that specific data point makes sense. As Kim was alluding to, look at the averages over 4 weeks, 3 months, something, and determine what the trend is. I'm sure the trend is accurate. The numbers are probably very questionable, but the trend is what's more important, and that's what probably should drive policy anyway.
Mm-hmm.
Well, the interesting part about it, Carrie, I'm going to let you speak because you wanted to just a second ago, is when you're talking about taking a look at the trends. Part of the issue on this past jobs report was they revised downward the number of jobs that were made available, or I guess people being hired over the last couple of months. And so that all of a sudden that trend that may have been kind of steady looks like a decline. Yeah. Am I right? Wrong?
You're right.
Okay, good. I'll start teaching at college now. Okay, go ahead, Carrie.
So I'll just throw a tidbit out, and then you can wrap this session, because I don't think we want to dive into this, but I've noticed the same thing, Stacy. Help wanted signs at small businesses, and I don't know, are people making more money on unemployment than they could working at a small business? So, this gets really into dynamics of the haves, the have-nots, minimum wage, cost of living, so.
Yeah, well, I guess that
open up that can of worms right now, but
no, but maybe it's down the road we will, because I guess that begs to the point of with inflation, while yes, Michael pointed out that the wages haven't been increasing, but I don't know that the wage increase is all across the board, especially for the small businesses, because they can only raise their prices so much before they won't get any business, I'm sure, I guess. All right. One quick point on this, though, if we can continue it, and that is this week, 2 inflation reports are going to be coming out. The producer price index on Thursday, and I think the consumer price index on Wednesday. Those were ones that would rattle the markets, and everybody was paying attention to them because the Fed was looking at those. Are they going to have any impact this week, do we think?
Oh, yeah, you betcha. Um, because these are the things, the Fed has 2 jobs, stable prices and full employment. That's their goals. So any kind of information on what is happening to prices in the most recent past is going to inform their decision next week. Now, their favorite measure is something called PCE, and that has already been delivered in the time period, in August. They're not going to get PCE until after this meeting. So they've already gotten their preferred number, but they're surely going to take a look, and the market surely will react.
Okay, good. This has been a very good but long session. We have to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. And we've been talking about the market and what the Fed may do. And Michael, the last time we met, you made mention that depending on what the Fed does, what action it might be taking, it might be time to take a look at bonds. Can you explain what you meant by that?
Yeah, I don't remember saying that, but I'll take a stab at that.
It was a little aside I picked up. So
fair enough. My hunch would be if the Fed, as we all know, data dependent, as Kim pointed out, they take a look obviously at the PCE and they'll look at CPI this coming week. But it's going to be a lot is going to be driven on whether they do a 25 basis point rate cut or a 50 basis point rate cut. And 25 would just kind of signal, okay, the economy's somewhat slowing a little bit. Unemployment's a little higher than they want. Yes, inflation's going in the right direction. Let's just get ahead of this and try to slowly stimulate the economy so we can bring unemployment back down and stimulate growth. If they cut it by 50 basis points, that could signal to the markets that, okay, maybe to Carrie's point, a hard landing or a recession is on the horizon. In that event, you would expect bonds to probably do a little bit better than they would do if it was a 25 basis point rate cut. Again, the good thing on the bond scenario or the bond side of things is bonds are finally acting like bonds over the past, 6, 7, 8 months or so, as opposed to what we saw in 2022 and 2023, where bonds and equities were directly correlated with one another. Bonds weren't the ballast that we've come to hope for in portfolios, but they've been acting more as a covariant asset to stocks over the past few months. So again, kind of depending on where the economy is headed and what the Fed does, I think bonds could be an interesting play, at least as a diversifier and a stabilizer should the equity markets falter.
Carrie, you want to jump in on that?
Yeah, I mean, I agree with all of that. It's, it's again comes back to the economic cycle and that asset classes, there are different times that it makes sense to own asset classes. And, the thing about bonds is that they really got hit hard this last cycle as interest rates went up. And for a lot of people that don't understand the dynamics of asset allocation, they've really steered away from them. But and all of that, as Frank said earlier, was swayed by all of the stimulus that came out into the market. So if we go back to really kind of more normalized economic times, bonds serve a purpose in a portfolio. And because of their relationship with how they perform during times of economic slowdowns and recessions, they really can support consistency of a portfolio. It's interesting because, it's not like, do I own stocks or do I own bonds? It's really about how the two work together to create that consistency of results over time. So the reason why people own bonds is that generally most people don't want to have all their money in stocks. A lot of people that are planning now, if you have a high risk tolerance, that's one thing, and you're young, you don't need income. But as you get closer to retirement or closer to a time when you may need your money, you need something that is productive, but isn't going to have the volatility, and in fact can offset the volatility of the stock market. So I want our viewers to know, it's not like we would ever say, sell your stocks and go into bonds. That's market timing. But when you look at the math and you look at the theory behind how portfolios, we call it portfolio optimization, how you can create those models, they serve a very important purpose. And knowing that we may be heading into a time where bonds may be performing well, that's the kind of information that causes us to want to rebalance portfolios, not market time and get out of stocks and go into bonds.
Okay, great. We need to take a break. Frank, was there something what you wanted to say?
It can wait.
Okay. All right. We'll take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. And we're talking about Fed action, bonds, all that sort of thing. And let's maybe this is tied to the bond market. There's no question the housing market has faltered through because of higher mortgage rates and a supply and demand problem. Kim, I think all of you have indicated that 0.25% drop in the interest rates by the Fed won't really do that much to help the housing market at this time. But the last time we got together, you also said it might help if you take a much longer look at the housing market. So what did you mean by that?
Sure. Well, for the past not even couple of years, let's say 18 months, people have stayed away from looking at housing-oriented and building-oriented kind of stocks. And that's because, when interest rates go up, you don't borrow to buy a house and fix it up. The borrowing has a whole lot to do with housing. It's just that easy. And as Frank pointed out earlier in this year, there was a lot of construction that was pulled through from the future, given low interest rates, loans from the government, loans that found their way that were supposed to be holding up businesses and may have held up the owners of the business a little bit stronger, and they put in that outdoor kitchen or pool or whatever. And a lot of that went on in the COVID era and a little bit after, into like 2022. And here we sit with a whole lot of people not looking to buy houses because that price of houses continues to go up. Even though demand is a little bit soft, it seems to be correcting at this point. But, up to this point, house prices have been really aggressively going up. And just the specter that we are going into a rate cutting environment might give you the opportunity to look for companies that are serving the building trades and the homeowners. And you may be able to pick up a few names that are unloved at this point, knowing that they can return to growth once people start putting that outdoor kitchen on or saying yes to the new roof they so desperately need.
And to add to that, we have underbuilt our housing stock for a couple decades now, and it has to get built. It's struggling with the cost of construction today. And tying it back to the employment reports that we were talking about earlier, it could be with the slowdown, contractors will be able to hire people at a price they can afford to pay and cause the housing prices to go down. The commodities like lumber, they're just commodities. They go up and down based on the weather or whether there's a boat lodged in the Red Sea or there's strife in Ukraine, whatever. All those outside factors will push those things around. But the employment situation, if employment can be stabilized in here, we can see maybe the cost of construction becoming reasonable instead of ridiculously high and unaffordable for many people. Let's hope for the best.
Yeah, that need for affordable housing is really, really dramatic. You have a lot of I'm not talking, low income housing. I'm talking affordable housing for most of America. And if you look at construction, what you mostly see are the McMansions. You don't see a lot of like what I would refer to as like starter homes. And that's a problem. So hopefully,
Well,
going forward.
would a larger rate cut over the next couple of months make any difference? I mean, would it really instill people to start to go out and buy homes if the rates are lower, and then maybe they'll start to build these more, as you like to call it, starter homes?
I
I
don't
mean,
know if
rate
that
cuts always help the housing market generally.
Okay.
So
I think they help, and at this point, though, Stacey, I think it might just help at the margins more than anything. I mean, if you look at all the housing data, whether it's building permits, new housing starts, mortgage application approval, they're all trending lower. If they cut rates a little bit, I mean, we've already seen the 30-year mortgage rates come down by more than a full percentage point, and nothing has really boosted. That hasn't really boosted the housing industry that much. So again, if rates come down a little bit more, will it help? I think it helps at the margin, but housing follows the economic cycle just like almost any other industry. Typically, at the start of a new economic cycle, coming out of a recession, housing is the first one that really takes off and does well. So, to Carrie's point earlier, if we're slowing down, if we hit into a recession, I don't think the housing market's going to get any better, even if the Fed cuts rates, until things sort of bottom out, and then we see a recovery in everything related to housing.
Wow. Well, I find that interesting because we've been, the economy has done so well, but the housing market has not. So I guess you're right. Maybe we need to hit that bottom first.
If you own a house, Stacey, you've done well. If you're trying to buy one, you have a problem.
Yeah, and 70% of people have locked in a mortgage rate below 4% or something like that. So, everybody on this call and most of our listeners are probably in that boat where I've locked in a 3% mortgage rate. Things are fantastic, and I can do things are great. It's that small cohort.
Right. I don't have to move at this point.
Right. Yeah. And if you want to horrify yourself, look at what rents are going for. They are crazy high. And that shows that moves more than home prices do, because people move in and out of places, right? And I mean, I think that shows you how hot the demand is for places to live, because the owners of the rental units can charge it. And things are just crazy high. And I'm speaking like I've owned my own home or series of homes probably for the last 30 years. But, you get immune to what it costs for a renter. And I have younger friends and I'm like, wow, you pay what to live where? And it's crazy. And I think that is an indicator that you can keep your eye on to see how serious the demand for housing is, because those renters really do want to join us in worrying about their water heater, as opposed to calling up the landlord saying something doesn't work. They would like to become part of the owner class and, build equity in the houses that they live in. It's just that simple.
All right. We need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We've been talking about the economy, the Fed, housing markets, all that sort of thing. But Frank, for investors, there's something called margin. What is that, and who should do it? And there's also something called a margin call. Can you delve into this for us?
Sure. Speaking of getting into the weeds, margin is borrowing money against your equities or debt or bonds. And brokerage firms lend money to their clients every day so that they can buy more stock or bonds. And this is done, and the brokerage firm charges interest. And today, the broker call rate, not that this is what you would pay because everybody has their own way of formulating this, but the broker call rate is 7.25%. So if you're going to borrow money to buy stock today and pay 7.25%, you ought to be hoping that you're going to earn more than 7.25% from that investment. My advice to my clients has always been, don't do it. And I don't like margin. I think loans are for real estate, not for stocks. Now, there are reasons to do it. Let's say you decide you're going to move and you find a house you want to buy, but you need to spend some money on it. So you can't sell the house you're in, and you have this equity portfolio. There's nothing wrong with taking a margin loan, a reasonable margin loan against that equity position, those stock positions that you own or bonds, and using it to buy the second house and fix it up, and then pay it off when you sell your house. That's a way to do it. Home equity loans are also a way to do that. All right. But it's all borrowing money, and that increases dramatically the risk you're taking in your portfolio when you do that. And most people are not equipped to deal with. We had a 4% drop in the market. Right. All right. If you had a margin account that was 50% margin, all right, that means you probably would have lost 6 or 7% in that period of time. And you'd still owe the broker the same amount of money, because the margin loan does not go down with the market. It stays the same. So it's very impactful. Back in 87, when we had the 25% drop or whatever it was in a day,
yeah,
all right, we had serious margin calls where the equity went down below 25% because the stocks they own were some of those stocks that got hit the hardest. All right, we had one guy who had a negative equity position. He owed us more money than his stock was worth. Almost put my firm out of business. We were able to negotiate a way to repair that problem and keep the firm healthy and give him an opportunity to recover. He didn't, but that's beside. He was taking more risk than he probably should have been. But all right, but we were monitoring, and it all happened in a nanosecond. Really, there's no way you could see it coming. He was fine in September. By the end of October, he was dead. It's terrible. And he was certain he was right. This guy wanted to start writing newsletters. He thought he was so good at investing. All right. So the point is, margin is a very dangerous thing to do unless you're really paying a lot of attention and you're nimble. And most people aren't, because their emotions get in their way, and that slows it, at best, just slows them down. Often it creates rigor mortis.
I mean, the best way that I can oversimplify it is, you have a house, you take a home equity loan with a margin, you have investments in a portfolio, you take a loan against those investments. The difference is that, as Frank was saying, if the portfolio value drops below a certain level, they're going to come knocking on your door and saying, hey, we need more money. And if you don't give us more money, we're going to sell what's in your portfolio. So when there's a lot of leverage and a lot of margin floating around out there, that's one of the reasons, it's one of the things that can lead to kind of a market decline perpetuating itself, because of what Frank said, that if you get a dramatic decline and now all of a sudden, your door's being knocked on and you don't have the money, then there's more selling that's going to take place just to cover those margin calls.
right.
Wow.
And here's a fun fact. A lot of the billionaires that, we'll pick on him. Elon Musk has a lot of his money tied up in Tesla, and he borrows for daily living or to invest in new kind of crazy ideas from his Tesla stock. And sometimes when Tesla goes down dramatically, he gets margin calls, as we've talked about here. And the bank, wherever it's being held, they'll just sell Tesla. So that can, if you're investing in a company, you need to watch out for this, that the founder still has a lot of it and that they have it margined out so they can live or invest. Because whenever this price goes down, they're going to sell that stock. They, being the brokerage house that's lent him the money, they're going to sell that stock to make themselves whole, because there's a percentage that they have to maintain in the percentage of assets to the loan. Okay, there we go. So yeah, you have to watch, because you could just be a harmless person holding Tesla stock and get clobbered because it went down and then down again because the guy owns too much of it. Does that make sense?
Makes sense to me.
Okay.
Look at 1929. margin requirements were 10%. If that was the margin requirement in 1987, we would have had a dramatic crash because the market went down 25% and all the margin accounts would have been underwater. All right. And they would have been selling on selling on selling just to meet the margin calls because the broker isn't in the business of taking that risk. They're in the business of lending you money and they want it back. When their collateral is impaired, which is the stock, they want to sell the collateral to get their money. It's not like real estate where if it goes down 10%, that's a big deal.
Yeah. Michael, do you want to wrap it up for us? Have any comments?
No further comments, Stacy.
Okay, we will take that then. We'll continue to take a look at the investing and the economy in future editions, and ask you once again that if you've been watching this segment or listening to it and you like it, please hit the subscribe or the like button on whatever platform you happen to be watching or listening to, and that will help keep this program going. But for right now, thanks for joining us, and we'll see you again the next time for The Bull, the Bear, and You.